And I think we can start. So welcome to this webinar on broadening access to finance for unlocking cold chain growth in Africa. My name is Michele Bruni. I'm the co-founder and CCO, Chief Commercial Officer of Inspira Farms, and I will be moderating the webinar today. Inspira Farms is building fresh produce cold chain in Africa, focusing mainly on on-farm and near-farm solution, designing, manufacturing, delivering, and financing cold storages and packhouse solutions that are for sure the most efficient and performant in the market and are all interconnected. I would like to thank the over 330 registrants to the webinar. We have registrants from over 20 countries, and to thank as well our panelists who will drive us to better understanding how really different financial tools and solutions can help us unlock cold chain in Africa. And I would like as well to extend a special thank to the team that has worked on preparing the webinar, and that will as well assist participants in driving question, in bringing questions and comments towards the panelists. In terms of agenda for the afternoon, we're going to keep it to 60 minutes to an hour sharp, with roughly 50 minutes of discussion among the panelists, and a final part with 3-4 selected questions from the audience, and a very short wrap-up at the end. For all participants, please address your questions in using the chat, and there is a team behind the scene that will help select and bring or aggregate some of those questions to the panel. I would like now to ask the panelists to introduce themselves, roughly 1 minute each, telling us about yourself and the organization you represent. And I would like to start with Amanda. Please, Amanda, and welcome.
Thank you to Inspira Farms, and thank you all the registrants for giving us your time this morning or this afternoon, wherever you are. I'm Amanda Brondy. I'm the Senior Director for International Projects at the Global Cold Chain Alliance. We are a trade association at our core, so we have members that work in different aspects of the cold chain, from transportation to warehousing to designing and building the actual warehouses themselves. Inspira Farms is a member of ours. And we also, unusual to most trade associations, we do have an international development arm through which we try to help the cold chain grow globally, using our members as our different experts, so that people can kind of learn from the lessons that they've learned as they've been building up the cold chain throughout the years. So thank you very much again. That's it for me.
Thank you, Amanda. I'm really looking forward to the discussion. Reem, hi, and welcome. Over to you.
Hi, thanks, Michele. Hi, everyone. So my name is Reem Azira. I'm a Senior Investment Officer at Sunfunder. Just before introducing Sunfunder, I'd like to start by saying that before being at Sunfunder, I was at another institution doing agricultural investing for more than 4 years. So cold chain financing, that's solar powered, is sort of bringing the two for me. So it's kind of my two passion in one. So really excited to be here today. Sunfunder, for the participant who don't know us, we are a debt financing institution. We provide loans for solar enterprises across emerging markets. We're currently focusing on Africa and the Middle East, with occasional sort of lending outside of Africa, but that's our core. We've provided around $100 million of financing, have just finalized the closing of our second fund, and essentially providing funding for any solar enterprises across the continent. So looking forward to the conversation today.
Thank you, Rim. Likewise. Thank you. Matthew, over to you. Hi, and
Great.
welcome.
Thank you, Michaela. Thank you, Paula, Mina, and Stephen, and all the panelists and attendees for making the time today for this webinar. I'm Matthew Meredith, the partner lead at the company LixCap for cold chain and agribusiness solutions. We are an economic growth development consultancy. Our clients are typically donors, agribusinesses, development finance institutions, IFIs, private investors, and our role is really as a blended finance specialist to help small businesses, SMEs, agribusinesses, and emerging markets access capital. We primarily work in Africa, Asia, Central Asia. We are members of the Global Cold Chain Alliance. We work extremely closely with Amanda Brondy and her team at the World Food Logistics Organization. We, in our role, try to use a broad range of financing tools, which we'll talk about later in the panel, to help unlock capital for cold chain and cold chain logistics. Looking forward to the panel.
Thank you, Matthew. Likewise, thanks. Jim, hi. Over to you and welcome. Just a brief introduction of yourself and your organization.
So I'm the founder and CEO of Untapped, and our focus is on equity and CapEx investing in emerging markets, including Africa. And so while we do quite a bit of equity investing in early stage companies, our real main focus is on providing CapEx financing, because we believe that that's one of the biggest financing gaps, especially in Africa. So our focus is really on how do you do CapEx financing to smaller organizations, SMEs in particular, so that we can really scale that out and de-risk financing to companies such as Inspira Farms, but also the smallholder farmers that need the services. So we're really focused on trying to expand access to finance through a different model of financing. Thank you for having me.
Thank you, Jim. And last but not least, Mina.
Thank you, Michele, and I also want to thank the Inspira Farm team and the panelists to getting this together, and as well, very impressed by the amount of attendees. So thank you everyone for listening today. My name is Mina, and I'm the CFO at Inspira Farms. Grew up on a farm in Sweden, worked on agricultural supply chains in East Africa over the last 6 years. Responsible for developing and managing Inspira Farms asset finance facility. Very passionate about reducing post-harvest losses in the regions where we're operating by reducing the cost of a cold storage. So creating more affordable cold storage solutions for our clients that are working really hard to grow, export, and aggregate fresh produce in East, West, and Southern Africa. Thanks.
Thank you, Mina. And probably I'll just spend a couple of minutes maybe to get us started with a brief introduction. So, in the context where we operate, we know that the lack of sufficient and efficient cold chain infrastructure is a major driver or contributor of food losses, and we know that that represents a missed opportunity for many agribusinesses to get into a fast-growing fresh produce global markets. We know that especially in sub-Saharan Africa, there are contexts in which almost half of what is harvested gets lost, and that the values that are captured by African agribusinesses on the global market are roughly 50% of the value that other regions are capturing. And even though there is a lot of potential, the trade of fresh fruit and vegetables from Africa only represents 10% of the global market. And so we really, what are the financial tools that, together with technologies and good design, can help contribute to reduce not only help us capture better the market opportunity, but as well reduce the environmental and social impact that those losses represent. And so I think we're going to hear about what are the needs for that capital access. How do we try and eliminate those risk-related barriers for agribusinesses and for operators that can be collaterals, can be impacts on cash flow, can be high premiums. And so I think that what we're trying really to do today is to try and learn and share why it is important to invest in finance and cold chain solutions for agribusinesses, what needs and can be addressed by increasing, improving, innovating on finance in agricultural cold chain, and what can be some of the most innovative and impactful financial instruments to support the increase and the development of those cold chains. With some questions to our panelists, and maybe I'll start with you, Amanda. From your privileged point of view, what is the current landscape of African cold chain development, and what are probably the most pressing challenges?
Thank you. Thanks for the question, and I'm gonna answer it, but I just want to kind of start off with two comments to kind of lay the foundation or set the stage. First is that cold chain encompasses many different actors, whether it's farmers, and that can be smallholders, or larger commercial farms, processors, cold storage, transporters, importers, exporters. There's so many different individuals and companies kind of throughout that supply chain. And so the type of investment really differs depending on whom you're working with. I think when I started my work at GCCA about 6 years ago, when I heard about cold chain investment, I think my mind automatically went to larger facilities, large scale facilities. And that's certainly one aspect of it. But when you're working on farm, you have to look at what is the most appropriate for that type of actor. And it could be something as simple as just evaporative cooling, and you work up from there. I think that the next kind of general comment I just want to note to all of our participants and panelists is that my perspective is really working with donors. And so I'm so grateful to have this panel with other experts in the finance space. So most of the challenges that I see are going to be from that perspective of donor and kind of development financing. So the first challenge that I identified when thinking through this question is that I think it's not ever questionable that there's a need for cold chain just about everywhere. Michele, you cited a lot of the food loss and waste that occurs. But I think that there's a big distinction between the need for a cold chain and then the actual demand that exists. When we look at cold chain investments and interventions, we're taking a private sector lens often, which means we want it to be sustainable. And sustainable in that context is often referring to whether or not the business will continue on. And it won't be able to do that if there's not a market to purchase or kind of help pay for the products. When you add temperature control or cooling, it will increase the price of the product. That price will get passed on to the consumers. And if consumers aren't willing and able to take on that increased price, then the business itself is not really sustainable. I think the second challenge that I've encountered a lot is the lack of coordination that often occurs among the different donors. I think there's been a really strong increase focused on cold chain among the donor community, which I'm very grateful for. And I think the donors have a lot of different strengths. In my experience, the IFC does a great job about taking a private sector or business side focus. USAID is a wonderful convener and they offer great training services. The Asian Development Bank does a lot for infrastructure. And I think that to the extent that those donors can collaborate openly and share information and work together, all of those different aspects at one time would do a lot to help advance a more integrated cold chain throughout Africa and in any country, frankly. And finally, with the focus on cold chain, there's been a lot of emphasis on funding for innovations and innovative ideas, which I'm a big fan of. A lot of our members are those innovators, but I don't often see the funding extend towards getting them to the next level. I think there's so many wonderful ideas out there, but it's the commercialization that is hard. And I know there's a lot of talk about scaling up, and that's part of it, but it's sometimes I get the impression that there's a sense that if you have a great idea, that idea is going to take off, but it's more than that. It takes a long time for people to uptake technologies. And it's a persistent, ongoing challenge that doesn't just disappear overnight. And it's not about just innovating. It's about working with those businesses and helping them to get their information across, demonstrate it. It's a sustained effort over a long time. So That's my comment on setting the landscape.
Thank you so much, Amanda. And I think that there is probably two of the dimensions that you raise. The need that I'm translating in. The need for sustainability, ecosystem, and collaboration that might be relevant as well in the next question. I would like to ask Matthew, from your point of view, what is the situation on finance for cold chain development in Africa, and what are the challenges and opportunities? And maybe as well to build on what Amanda was saying on this need of collaboration, of ecosystem, of coordination between different actors.
Sure. Thanks, Michaela, and thanks, Amanda. So we look at a pretty common problem set regarding cold chain in pretty much every market we go to. So we look at the creditworthiness, of course, of a company that's interested in investing in the cold chain. We understand that in most markets, there's the lack of technical skill sets to both operate the cold chain as well as upstream at the farm level to create a product quality that justifies an investment in the cold chain. There's a lack of collateral. There's a quantity and quality issue required to invest in cold chain logistics assets, whether that's rolling stock like trucks, whether that's a hard asset like a storage facility. You have to have a certain quantity and a certain quality to justify that investment, and that has to be sustained throughout the year. So that leads us to a secondary issue, which is a value chain approach and a market systems approach. And a lot of the donor communities that want to promote cold chain access, they're focused on a single value chain that may have a harvest period as short as 3 months. And you can't justify cold chain assets simply for 3 months worth of product throughput. Then there's the market systems access and the willingness to pay issue that Amanda has already articulated. There's problems in the systemic approach. And this is, Michaela, to link to your comment about how do you integrate these different stakeholders, you have a systemic issue. So if you only focus on near farm or on farm cold storage logistics assets, how do you move that product coming out of those facilities, however small they may be, and move them to market that maintains that quality and that justifies a higher price and higher willingness to pay that you need in order to offset those costs of investing in a cold storage facility? This problem set we see in every single market. So what we try to do is bring a range of tools and a range of stakeholders to bear to provide access to finance to support cold chain assets. And we look very much at the capital and financing stack. And we also look at providers like Sunfunder. We, of course, also are looking at other financing providers. So think DFIs, think IFIs, think local banks, think local leasing organizations, and try to bring a broad range of different financial tools together in order to comprehensively address both the financing needs, but also the ecosystem needs for a cold chain investment. So thinking about the ecosystem needs and the upstream issue, we look at technical assistance. Technical assistance can come from a variety of sources, frequently from donor organizations or NGOs that are already working with cooperative groups to train them on how to use cold chain assets, how to do post-harvest treatment in order to ensure that there's a sustained and sustainable quality and quantity of product to use those cold chain logistics assets. They're great tools out there. Of course, there's Sunfunder who's on the call right now. There's also revenue-based financing, which Jim's going to talk about. There's equity tools, hard to come by equity in emerging markets, but it exists for the larger agribusiness type companies. Debt, of course, everyone thinks banks when thinking financing, but banks have a couple tools at their disposal. Banks have, of course, term debt tools. There's also leasing. There's also credit guarantees, and there's organizations that provide credit guarantees. There's also how do you do the market assessment and needs assessment? There are grant-making bodies out there that have tools and have funding pools available to provide grants to agribusinesses looking to invest in cold chain. So we really look very broadly. We look at a range of stakeholders. We look along the market system, starting at the producer side and even on the input supply side, to look at how do you comprehensively put a financing structure in place, both for the asset, but ensure that the ecosystem that is going to use that asset is capable of both providing the product quality, providing the quantity, but also enabling systemic access to the markets to justify the throughput for those assets and those cold chain linkages. Thanks, Michele.
Thank you, Matthew. And I think that building on what Matthew was saying, there is a lot of ecosystem dimension. There's a lot of different opportunities. There is a lot of different angles that we can tackle. And probably moving more for all participants to experiences on the enterprises, or how some of those financial tools interact with the specific needs of a business. I would like really to ask Rim, in your experience and the one of Sunfunder, how do asset finance on cold chain can really support those gaps and opportunities, and what are as well some of the challenges that you face? I mean, we know that fresh produce needs to be refrigerated as close as possible to the source, and that is a fundamental need for especially exporting agribusinesses, but as well other type of agribusinesses. And then there's the volumes, the quality, the cash flows. Can you tell us a bit about experience and vision on what you do?
Sure. Thanks, Michele and Amanda and Matthew for your comments. Let me just start by saying that everything that we collectively as participants in this ecosystem are trying to achieve is immensely complicated, because you're trying to solve an issue which is fundamental, that brings so much, that sort of brings together so much difficulties that are not necessarily linked to the cold storage. When we talk about an agricultural product, when we talk about productivity of the agricultural, an agricultural farm in Africa, it's just such a wide topic by itself. When we talk about processing, when we talk about capacity to pay for end users and so on, all of that is really large. So if we try to narrow it down to what we have here today, I would say that for us, the challenges have been the following, and some were already mentioned by Matthew and Amanda. Definitely scale has been one of them. So one thing that we don't want to be doing as a lender is to overburden a borrower and provide him with a financing tool that doesn't suit its needs. So definitely, as we saw this segment of the market grow, we're seeing the scale of the need and the scale of the financing needs grow. And I think that's going to bring a lot of efficiency in the way we provide our loans. But yeah, just starting to say that scale has definitely been one of the challenges that we initially faced in the subsegments. The second one I would say is the fact that standardization in this segment is very hard. Cooling or freezing or packing strawberries is highly different than oranges, beans, mung beans, etc. So there is a certain level of technicity and of sort of fine tuning for every single unit and asset that Inspira puts out there. And as a consequence, there is a financing need that has to be tagged to those sort of specific cash flows from that specific farm. So the fact that it's not by definition very standardizable makes it a bit more challenging. The last point that I wanted to mention was to do with what Amanda was referring to, the sustainability and really the business case on the long run. All of this takes time for it to bear its fruits, no pun intended. So for the end users to understand the benefits on the long run, for the end users to understand the benefits, for the donors, for us as lenders, etc., for the entire community to see that this is something that could have a huge impact on the continent, is going to take time. And we have to be the innovators here, and we have to show the world that it works. What have we tried to do? Well, very much with Inspira, that has been one of our partners since a while now. We've been trying to find a way to finance this on an assets-based sort of structure. Why? Because we think that it would allow first Inspira and other Inspiras of this world to grow sustainably. So sort of releasing them from the burden of raising funds every time they sign a new customer. So finding, a platform or putting in place a platform that could help them grow much more efficiently. The second point is to try to cater for the cyclicality of the revenues. As Matthew has said, harvests are really short. We have to live with that cyclicality of the underlying business, and having a financing tool that is sort of built on that cyclicality of revenues and has a repayment pattern that's molded into that cyclicality helps tremendously. And the last point is really the portfolio approach in our mind. So having a facility that caters for different end users that have different strength. Again, picking up on Matthew's comment earlier on credit worthiness of the end users, that's also a way to do it. So bring together end users that have different strengths and weaknesses.
Thank you. Thanks, Rim. And so I do think that there is, a lot of interesting elements that are really reflecting the nature and the context of many, highly productive areas in sub-Saharan Africa. And I would like probably to ask Mina, if you, from an Inspira Farms perspective, can you share some specific experiences on building on what Rim was saying on how that asset finance has unlocked opportunities specifically for agribusinesses. So, changing slightly the perspective, when that has been a success, what has happened to the agribusinesses? What were the key factors?
Yeah, absolutely. Thank you, Michele. So when we speak about the cold storage and pack house facilities that we are selling to our customers, and the affordability of it, what we really want to see, and which we have seen, is that the cold storages essentially pay for itself over time, and that's how they become affordable. So very straightforward examples. Almost all our customers have experienced from certification of our cold storage and so on, but just 3 very tangible financial positive effects that the cold storage has for them is 1, reduced rejection from their customers, be it export markets or local market, but most of our clients have seen that they have had reduced rejections, which obviously has a monetary value of their business. The second part is the reduction of post-harvest losses. So instead of having to drive to the closest cold storage, our sort of farm-based cold storage has reduced the post-harvest losses in that first mile, which also has a positive financial effect for the agribusinesses, and as well for the smallholder farmers that sometimes capture that value as their produce don't get lost. And the third point is that most of our clients buy a cold storage or pack house solution because they want to increase their volumes that they are selling. So there are effect of increased revenue when we have finally commissioned the cold storage unit. So those 3 effects essentially enables the agribusiness in many cases to pay for the cold storage under finance. So the financing that we right now have available thanks to Sunfunder is a 5-year financing facility where we can finance 80% of the invoice value with flexible repayment schedule to match the harvest, because we acknowledge that agribusinesses usually have strain on the cash flows because of seasonality, and we also don't request any additional collateral. So it's purely ring-fenced around your Inspira Farms facility. But yeah, so to answer your question, Michele, for our customers' point of view, it's really about creating an investment in a productive asset that will pay for itself over time, and that's what we are very excited about here.
Yeah, and probably just thank you, Mina, and probably just to add one point for the ones that are not so specialized in agriculture, but there are high value crops for which an hour of delay from the picking to the cool down might represent 1.5 days of less shelf life. So if you start thinking about the distances that we might be facing, the remoteness of certain farms, we can understand as well what the economic value of that can be. So thank you, Mina. Jim, last but absolutely not least, in having heard the different perspective from really the landscape dimension to some of the more specific experiences on asset finance, in your experience as an investor and innovator as well in other industries, what is your take, or what do you think the sector might need? I think I cannot hear you. I'm not sure about the others. Apologies on that.
Can you hear me now?
Yes, thank you.
Okay. Yeah, sorry about that. Technical
No
issues
worries.
on my side. Yeah, so I think from listening to the other panelists, there's a significant and clear need for financing. And there's also very significant evidence that it unlocks a tremendous amount of value, as everybody has said. I think the question really is, how do we actually provide some of this financing? And we often go to the same kind of tools that we always go to, your standard debt instruments, your standard mezzanine instruments, and so on. I think there isn't enough innovation in the financing of innovation in that sense. And so I think there's an opportunity with what's happening on the digitization side and what's happening in the market in general of finding new ways of providing financing. And I'm very happy to see Ren from SunFunder talk about different more revenue-based models for providing or even looking at the financing and not taking the collateral, but only ring fencing it around the assets. But I think we can take one step beyond that and really look at digital payments and revenue streams that come from digital payments and assets that are controlled and managed from IoT and other remote management tools. Because I think it really changes the picture of how a lending institution or an investor can look at an asset and potentially provide financing for that asset. So for example, in your typical project financing, you are going through the future revenue streams of that asset and of the project and basing your financing around that. Well, oftentimes that's a very arduous process. I've gone through it myself. It is very arduous and takes a lot of time and a lot of money for that legal process to come through. And so that means only very large scale loans or financings are possible. But with the digitization that's been happening in the last 2 decades, I think we've seen a shift in how that could be done, in the sense that if you're able to lend against assets, pay-go assets, for example, that provide a direct revenue stream, then it's possible to lend against those revenue streams and change how you're doing the lending. Now, what does that mean on a very practical level? At a very practical level, it means you can shorten the time of analysis. You can lend to people at scale that don't have your typical collateral or balance sheets. You can reduce the administrative cost of providing financing, and therefore reduce the administrative burden and the default risk longer term, and therefore provide greater access to more borrowers, instead of just the larger institutions, larger companies that have, everything lined up to be able to lend to the IFC. So I think we just need to look at things differently instead of approaching it as every other bank and every other lending institution has, and approach how do we get financing to
smaller enterprises in particular more effectively, more scalably, so that we can unlock value there and not just with the larger institutions.
Thank you, Jim. And if I can probably commenting on a couple of the points that you raised, I do think that there's something as well extremely exciting in in working in areas, whether they're industries or countries where there's a lot of need or the infrastructure is really shallow, because actually we do not have to make again all the mistakes that were done with all the type of development stages that were done maybe in more industrialized countries. And so
right.
for us, it's extremely exciting thinking about new and new business models that can really be led by that IoT dimension, but those digital payments. So we don't need to really rebuild the infrastructure, thinking to go through all the steps and all the trial and error that we've already done, but trying as well something that is radically different. And I think that is extremely excited. And probably yeah, please.
I was going to just pick up on a piece that you said. I think it's about changing the lens through which you look at these potential financings. Because we're using the lens, we're using the same models that we've used, that we currently use in developed countries, and apply them to the markets that we're working in now. We're going to miss opportunities, and that's what's happening, right? Because we're applying, for example, a formal economy lens to this. And if you do that, then you miss out on the informal economy. And so if you miss out on the informal economy, which is the majority of the economic activity in many of the markets that we work in, you're actually not just leaving out a large number of entrepreneurs and businesses, but as an investor, you're missing out on that growth opportunity. And so we see it anecdotally all the time in terms of, a loan shark lending out motorcycles so that drivers can make money. What if we can turn that into a more standardized business that is not as exploitative as a loan shark is? There's a lot of value to be unlocked for investors. At the same time, there's a lot of economic empowerment that can be given to thousands, hundreds of thousands of people. So I think using that different lens of how do we assess risk, I think is key here.
Thank you. And probably on innovation risk, I would like probably to spend a few minutes in seeing if there is questions or comments from the panelists to other panelists, or even if there is challenges to something that one of you has said.
I don't want to hog the limelight too much, but I just think from an investor's perspective, you're right. There's so much, I hear so often from entrepreneurs, will you invest as an equity investor? Will you invest? Will you give me a loan? And so oftentimes those propositions just don't make sense for an investor, right? So I think it's about better aligning, using different instruments to align the incentives of both the entrepreneurs and the investors. And so revenue-based financing or revenue-based loans is a great way to do that, because you can share in some of the upside without taking equity in the company. And so I think we often default to these very basic instruments, equity or debt, when those two instruments in many cases simply don't fit. So I'll stop there and put myself on mute.
Thank you. So I'll probably on that, can we have a quick round? Matthew first, and then Reem on on innovation, new models, revenue sharing. From your point of view, how does that play now and will play in the future?
Sure, and I would love to echo as well Jim from Untapped's comments about innovation in finance. We definitely have a bias if we're coming from a developed market, how we look at emerging markets. But now those of us who, of course, on the panel have been working in emerging markets for years and understand that there's a big tool, there's a big toolkit available. particularly for agribusinesses that are aspirational and growing and looking to invest potentially in their first cold chain, is really thinking broadly about how to access finance and understanding access to finance really on a continuum of increasing sophistication and understanding the entirety of the market system in which one is operating in order to be able to access that finance. Because being able to access finance, yes, you're trying to access finance for very specific assets in cold chain, but that requires a lot of other things to work in order for that asset to be justified. That also means there's a broader range of potential stakeholders that can be engaged that have different financial tools available to help create that access to finance. And that's really where we as a blended finance shop come in, because we may say, okay, early in the process, you're going to need some technical assistance from maybe a donor organization or development organization, or maybe a program that's run by your local government or your national government to help design the business plan to articulate why you need to invest in this asset. And that business plan is part of the process of doing the application to a lender, or maybe to Untapped, or maybe to Sun Funder to be able to justify the overall financial concept. But then you need to work with your aggregators, your purchasers, and your wholesalers to look at what your offtake agreements are in order to make sure that whatever throughput you're handling actually has a market. So when you're thinking as an entrepreneur and you're trying to figure out how you're going to get access to finance, you really have to think broadly. You have to think in an ecosystem or a market systems approach, and look at the different tools that can be brought to bear, whether that's grants, whether that's technical assistance, whether that's a guarantee if you're looking for credit from a local lending institution, whether you're looking for an alternative financing source like Untapped or Sun Funder, and then also looking further downstream at some of your buyers, potentially having your buyers provide some financing or some guarantees that'll make sure that you, when you have your credit application together, whether for debt or potentially a funding application for equity or for funding application for grants, that you have a much broader approach as opposed to showing up, I need money for my asset. You don't need money for your asset, you need money for a whole business system in which your asset is located.
Thank you. Thank you, Matthew. Reem.
Thanks, Michele. Yeah, and thanks, Jim. I totally second your comment on need for innovation and digitization and IoT-enabled asset and so on. I mean, at Sun Funder, we've been financing solar home system pay-goes for 8 years now. So we've been, yeah, we've been there for a while. We've seen the ups and downs. So it certainly has its merits when it comes to enabling more financing and channeling more financing into a specific segment. But I'll have to echo some of Matthew's comments when it comes to, you know, trying to understand the chain and where are the risks? Because as long as certain digital tools can certainly help us and have been helping us to understand payment patterns, et cetera, having a tool that allows access to payment easily, et cetera, but that doesn't sort of prevent us from having to understand what are the underlying risks that such an entrepreneur is taking by accessing that asset that's going to help them sort of unlock significant more revenue, capital, et cetera, later on. So as long as it's a tool, we've learned that it's a tool to sort of use carefully and not to forget about, the fundamentals of agriculture and cold storage in this instance.
Yeah, absolutely. Let me just comment on that, Grim. I think it's absolutely critical that we're focusing on, when we're looking at the risk profiles, you're focusing on the core business, right? And I think if you look at traditional lending, it's always around the core business of a specific enterprise. And it's always been enterprise focused. I think there is an opportunity with digitization to be more asset focused, right? And look at the business model around the asset, because in many ways with digitization, you can create a much more direct connection with the revenue streams on the asset versus relying on the enterprise to repay. And so I think when you start looking at the business models around assets and putting less emphasis on the risks of the enterprise, I think the algebra can change, or the calculus can change on evaluation of risk.
Yeah, and I will complement by saying that for me, the off-takers will play in the future a fundamental role in these. And I think as well that supply chain finance will evolve because as well with the fluctuations and uncertainty that we're going to have related to climate change is going to be fundamental, more sharing and more pooling of those
Absolutely.
assets. Amanda, and then Mina. You really look at probably worldwide many different projects and development from the Global Cold Chain Alliance. What's your take on some of these innovations that we're discussing? And probably as well, following up to that, do you think that the type of donor community, type of the ones that are supposed to be funding innovation or pre-competitive spaces, do you think they would buy into these type of concepts?
So my first comment, I was actually reading through some of the chat and things as a discussion was occurring, and I think then listening at the same time to some of the panelists, and what kept coming to my mind also is with cold chain, it's not just about an asset, and it's not just about getting it built up. It's not as if you've got a cold chain and now everything's great. There's consistent and ongoing training that has to occur with the individuals who operate facilities. And I don't know that this is necessarily the discussion that we need to have today, but I think it is worth mentioning that from our perspective, probably the number one thing that we get asked about is just simply commodity storage. And that's critical. If someone like Inspira Farms is putting up a unit in a country, and the individuals who are working with that unit don't know how to store product, and they store it incorrectly, or they don't remove field heat, or they don't allow for airflow around it, then that product's going to be destroyed. And the impression at that point is that cold chain doesn't work. And so when I talk about training, it's really the operational training about how not just to manage the unit. And it's not always about maintenance. That's important too, but it's really about understanding what products can be stored together. What's the ideal temperature for those products? That type of training, that type of knowledge base is probably the most important. I may regret saying this one day, but in my mind, that's just what I always come back to is you can't really run a cold chain without knowing that. As for your second question regarding the donors, I mean, I can only hope that they would be open to it, and I think that they will. What I've seen over the past 6 years is just an increasing focus and an urgency in wanting to address the challenges that cold chain is a solution for, but doing it in a way that builds upon some of the lessons learned from the past. And so I think donors are keen to learn about how best they can support this. So I can hope that they would be, and I'm an optimist, so I think that they will be open to all of this.
Thank you, Amanda. Mina, last but not least, and then we're gonna open up to some Q&A from the participants. There's been many questions that have been selected. Thanks to the team for doing that background work. Mina, what's your take on these? I mean, and as a CFO, do you think that it would be a challenge, an opportunity? How do you see like the innovation that can be brought to those agribusinesses?
Yeah,
and smaller.
Yeah, exactly. I mean, so there's obviously a pattern here, and I think after doing a lot of due diligence on clients, as in Inspira Farms clients, to get credit approval, where we sort of really balanced the risk, and I've heard it a lot today, it's on the operations. And there is a lot of good operators in this space that won't get financing because they don't have the balance sheet, they don't have the credit history, and normally they are traders in a sense, so they don't sit on larger balance sheet that the banks will finance, and that for me, that together with the unit paying from itself is really where the innovation can happen here, and work with investors like Untapped and Sunflower.
Mina, I guess we lost you. I think we lost Mina. Let's move to a Q&A because we only have 10 minutes left coming in from the participants. There's been really a few questions on what can drive down the cost of cold chain solution. Understanding that the payback can be slow. So anyone wants to take that one quickly? I know if Amanda, Matthew, Rim, do you want to quickly say anything on driving down the cost or accelerating the payback?
I can jump in quickly. I won't be the expert on finance. Perhaps Matthew or Reem can answer to that. But I'll just say, when looking at cold chain, again, there's not just one type. And so as for driving down the cost, it's looking at what is appropriate and what meets the needs for that particular market. Are you looking at a domestic market? Are you looking at the informal market? If so, are there smaller scale, lower cost technologies that you can utilize? Doesn't have to be a full-on facility that requires electricity or generators, or even some of the solar power. I think that's amazing, but perhaps we're even at a smaller scale than that. Matthew, I think I'll switch over to you to see if you have comments more on the financing.
Sure. So driving down costs and increasing payback period is a function of volume and service that can be provided. So whenever we are talking about a cold chain installation and a cold chain services company, we try to take a multiple value chain approach and a multiple service approach. And we always look to put cold chain assets at a location that can do import, export, and local market from domestic consumption from local production. Now, of course, that's not always applicable, but even if you're doing an on-farm cold chain asset that's in a production zone and far from import-export nodes, looking to bring in multiple value chains across multiple harvest cycles is the way to increase throughput quantity and presumably throughput quality that's going to help you amortize those assets more quickly. So really looking at a broader ecosystem and a range of different value chains that can come to those assets is a way to increase your revenue, shorten your payback period, and amortize your costs, and therefore lower your price.
Thank you. Just one message to all participants. I mean, there's been many questions on the Q&A, and we will just take another couple of them. We will follow up individually as well to the questions that are not going to be answered today, and a lot of the stuff is going to respond over the next couple of days. I heard someone else wanting to intervene.
Yeah, really quickly, Michele, I just wanted to say that, I second Matthew and Amanda on their comment on reducing cost. I think from our side, what we've been trying to do is to be as close as possible to the cash flow. So reducing the payback period to Matthew's point. So being close to that cash flow helps pay less interest on that money that's outstanding. So that's been our contribution. The second point to it is the portfolio approach I was talking about. So pulling together end users that don't have necessarily the same credit worthiness helps bring the overall cost of a structure down also.
And then there were, a few questions that were related as well to, I would say, two groups of questions. One on climate change and how can these work under climate change scenario. And I think that I can briefly build on this, but there's a lot of opportunities both to link these to carbon emission reduction as well as to justify investment in cold chain as a way to reduce the impact on certain chains. There was another question, another set of questions on where are, if you want, the buyers and other logistics operators along this chain, and and whether we can work with them. I don't know. Maybe Matthew, can you spend a couple of words on that, and then I can complement.
Sure, Michaela, you mentioned supply chain finance, and we look also systemically, and this is the market systems approach, about how you bring in those logisticians and how you bring in the buyers along your supply chain and along also the market systems chain. So from production, intermediary transportation, storage, to wholesale markets, and ultimately to HoReCa, hotel, restaurants, caterers, modern grocery retail, or even export. How do you integrate with them? And so what we have done in other markets is look to partner with logistics companies and try to reach agreements with them to make sure that they have the right types of vehicles, so normally cold chain vehicles, available to bring that product from the market or from your cold storage facility to the markets. And that way you have confidence when you're talking to your funding sources that you can maintain the product quality that a wholesaler, for example, will be willing to pay for. And really integrating them into your overall concept and bringing that partner to the table when you're looking to apply for financing can substantially help give credibility to your process and to your project.
Thank you. And responding to a lot of the questions on on paybacks and what are the type of assets and what are the type of collateral, I think that we're going to follow up specifically on that, especially because we have 2.5 minutes left. And so I would like, first of all, to really thank the panelists for participating and actually really exciting discussion. I think there's, at least for my taste, that could have gone on for another hour and a half. I have so many questions myself. This would be a fantastic group to respond to that I would be privileged. I think that briefly we've seen, I think we've gone through a journey from really the trying to understand the macro level challenges or opportunities, down to understand both the assets and the enterprise challenges and opportunities, the complexity of setting up a cold chain in which by definition the cold chain is as good as the worst link. And so that needs to increase efficiency from a really ecosystem perspective. How we can really innovate on the financial models, but as well on the underlying technology that allow those assets to generate benefits. And remembering as well, and probably touching, even if not enough, on climate change and some of those challenges related to uncertainty. I do strongly believe on that data, IoT capabilities, and working as ecosystems, as multiple platforms, can help buffer some of those challenges in an industry that is defined by uncertainty. And probably to all the agribusinesses that are participating, there is not many other industries in which an entrepreneur does not control the production method, the cost of production, nor the price. And so as well, my deepest appreciation, both as a citizen and consumer, as well as an entrepreneur, to everyone, to all farmers and agribusinesses in the world, because their work is really tough. And on that note, I would really like to thank everyone, especially the 150 participants that stayed for the whole hour. And thanks a lot to all panelists, and we're going to find a way both to reply to all questions and as well to follow up with many of you. Thank you so much, and I think it's 5 o'clock exactly Central European time. Good morning, evening, and afternoon to all of you. Thank you.
Thanks, Michele.
Thank you so much, everyone.
Thanks.
Thank you.
Everyone,
Thank you.
Thank you so
Thanks.
much, everyone.
Bye-bye.
Bye, everyone.
Thank you. Bye-bye.
Thank you.